Yeah.
Thank you for joining me today on the Wealth Press Midas table. Roger Scott Friday afternoon weekly wrap. I'm coming to you live from the Kubota tractor as I head back to my farm. Roger, let's talk about the week that was. How did the riots affect markets, and what's our takeaway from all this, formulating our strategy for the week ahead?
Well, I'm glad you asked, James. It's very, very interesting. It's almost like the market it's almost like there were no riots. The markets were very, 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 the markets were literally doing their own thing. They were completely ignoring the riots. We did see some upside in gun and outdoor related stocks, but the riots were not the biggest factor. The biggest factor was the markets are starting to look past the stay-at-home stocks. That's the biggest factor, not the riots. The riots impacted a couple of sectors. Gun stocks went up. A few taser stocks went up. I've got a couple of tickers for you, actually, before we're done with today. No, maybe you can pass me those stocks. The first three there. Yeah, those. Yeah, I want to give you a few, but I'll do that later. First off, I wanted to say that this week was the first week we saw a major shift in momentum. There's a lot of things going on right now that people are that is right beneath the surface, and it's about to come out. For the first time since this pandemic hit, the S&P 500 has been outperforming the technology, consumer discretionary, and healthcare. Last week and the week before, we've seen a lot of upside from companies that have been completely on the sidelines. Material stocks, utility stocks, consumer staple stocks, financial stocks, and energy stocks. They all started gaining and technology started going down. But here's what's interesting. There's a couple of very interesting takeaways. If you looked at the bond market, you will notice that the bond market, even though the NASDAQ 100 was going up, the bond market did not give out, and it did give out finally, but it gave out exactly at the time when the S&P 500 crossed the 200-day moving average. In other words, the bond market was sitting and waiting. It did not trust the recovery to begin with technology, consumer discretionary, and healthcare. It wanted to see money flowing into other assets before bonds took off. If you literally look at the bond market and when it took off to the downside, and you look at the days the S&P has been the moving average, they are within 1 day of each other over the last 2 weeks, literally 1 day off of each other. So it's very clear to me that the market was not very confident in the tech recovery, but now is becoming a lot more bullish as a result. But with that said, we have something really, really disturbing on the horizon, James, something that no one is talking about right now. And this is something that we haven't seen in 20 years. The only time we've seen it the only time we've ever seen this was when the market crashed in February. And we're seeing it again right now. We are seeing 97% of stocks in the S&P 500 trading above the 50-day moving average. That is extreme momentum, and that kind of momentum cannot sustain itself. Imagine the rubber band stretching out, and stretching out. Well, it stretched out like this right before the crash, and I was warning everyone that this was going to happen because it was stretched out like this, and then the rubber band, snapped. And now it's again, but in the other direction. But here's the bigger problem. You only have 47% of stocks trading above the 200-day moving average. So you have 90. So the main trend is still down because you still have less than 50% of stocks trading above the 200-day moving average. But the short-term trend is skyrocketing. And these levels, it is impossible for us to sustain these levels. So I am seeing the exact opposite of what we saw after the market cooled off.
Wow, That's
Yeah.
just phenomenal, Roger. So what does all this mean? Does this mean we're on the precipice of one of the biggest meltdowns of the stock market in history?
Well, here's what it means. If I am right, and this is very dangerous, it means that this V bounce that we've been seeing since February is just, if I am interpreting everything correctly, then this V bounce recovery that we've seen in the last 2 months is nothing more than a dead cat bounce, and the market should revert back down. And the only reason why we rallied so hard was because we dropped so hard. Remember, the S&P is just 2 weeks ahead on the 200-day moving average. This means we could come right down and it can continue that bearish downtrend. See, a lot of traders are seeing this as a new leg up. According to what I'm seeing right now, this is just a temporary bounce that's going to lead us lower. I can't say the market is bullish till at least 60% of stocks are trading above the 200-day line. We're only at 45%, but 97 are trading above the 50-day moving average. That's crazy.
Oh, I've never heard of that.
Well, that we haven't seen this on a monthly basis in 20 years. As a matter of fact, my data only goes back for this 20 years. So this could be historic. I can't tell you. I can only go back 20 years. So this is really, really big. And again, Wall Street, no one is talking about this. But this is major. It's eye-opening. And this is something investors have to be very cautious about. Now, there's two ways this can ride out. We can stay there for a couple of more weeks, and we can very slowly start coming down. But that usually doesn't happen when that rubber band stretches out. As a matter of fact, it hardly ever happens. Now, because the 200-day moving average is so vulnerable, even right now, because we still have less than 50% of stocks above it, and if the 50-day bends, we could take this market down quite a bit. Now, I don't know if this is going to mean us testing the bottom or not, but there is a very, very high percent chance that we are going to start dipping down. A very, very high percent chance, James.
So should we go short, Roger?
Well, I don't know about going short right now. Here's what I would do. I would go short the stocks that have not given us any bounce. The UBS Bank, a couple of bank stocks, a couple of retailers. I would still only short stocks. In other words, I would not want to follow the strategy of buying the strongest stocks right now. I would still want to follow the strategy of selling the weakest stocks because they're going to go weaker and weaker and weaker. So stocks like Dave & Buster's, ticker symbol PLY, for example, that's a very good shorting stock. Stocks that were suffering before the COVID-19 hit. A couple of bank stocks, definitely a couple of energy stocks. But I wouldn't want to be selling stocks or fading stocks that are above the 200-day moving average. I would want to stay with the same strategy, and I would want to sell the weakest stocks right now, just to be on the safe side. If we see the follow through that I'm thinking, then it would be good time to go short when the S&P breaks the 200-day moving average. But right now, I would feel a lot more comfortable staying with the original plan and just hunting stocks or following stocks that are just doing horribly no matter what, and never ever were able to gain that upside that I'm talking about right now, even in the short term.
And what about the bond price? And what about the interest rates, Roger? They've been rising rather dramatically in the last 10, 20 days. I mean, the short-term rate, they're still at rock bottom, but the curve has just gone so steep. Yes.
And we've seen that in the futures price too. And that's the precipitation for that was the S&P 500 breaking above the 200-day moving average. But here's the problem, James. And this is going to be one of the most important things I'm going to say here right now. You got to keep something in mind. The market is capitalized weighted. So you got a bunch of dummies looking at this chart and they see the S&P 500 cross above the 200-day moving average, oh, the market's bullish all of a sudden. It's time to sell off bonds. It's time to buy in, it's time to sell bonds. Well, the problem with that is they're forgetting that US stocks are capitalized weighted, which means unless you look at them internally, like I'm proposing, you're never going to get a good sense of whether the market is really bullish or bearish. You can have 15 stocks in that S&P driving the entire index higher because of the market cap. But when you look at it internally, it tells a whole different story. And the story right now is the market is still below the 200-day moving average when you look at it internally. And I believe everything we're seeing with the bond market is going to undo itself completely in the opposite direction, because those traders who are selling the bond are looking at it technically and not looking at it internally like I am.
Wow, what a scary time to be an investor.
Vulnerable, very vulnerable time.
Right. So then, Roger, what is your recommendation for people who want to take on a little bit of risk, want to try to capture the opportunity inherent in the volatility, but don't want to expose themselves to total losses?
That's a great question. Something started happening, big started happening the last 2 weeks. We've been having riots here in the country, and they're getting international, and it just doesn't seem like things are getting any better. Gun stocks and taser stocks have been seeing a lot of upside. The indexes just crossed the 200-day moving average to the upside. I'm looking at Sturm Ruger, ticker symbol RGR. I'm looking at Axon Enterprise, ticker symbol AAXN, a maker of tasers. They've been just getting tons and tons of orders from municipalities and local governments. A lot of police officers are going to be switching to tasers. A lot of federal government aid is going to be given to go into tasers. So government is buying tasers. People are buying guns. Let me give you some numbers here. Over the last year, we're at 45% increase as of last month, before this thing started, before this Floyd thing started. As next month we're going to hear they've probably doubled gun sales as of a year ago. So we're going to see a nice big spike with major gun manufacturers like Ruger, ticker symbol RGR. And again, watch, if you're not into guns, tasers. I don't think this is going away anytime soon. I think there's too much vulnerability. There's too much uncertainty. Summers are technically known for people get a lot more violent in the summers. A lot more deaths happen during the summer months. A lot more crimes happen during summer months. We're now having the same thing in Europe as a result of what happened here in Minneapolis. The whole police department is being disbanded. This is not going anywhere. And if you want me to be very frank with you, I believe a lot of this has to do with people being pent up in their homes, a lot of anger, a lot of frustration as a result of unemployment, COVID-19, all that taken together with the summer months and this thing that happened in Indianapolis. It's a big mess. It's a big mess, James.
Wow, amazing, Roger. Well, I guess we just try to stay liquid, and I guess after our loved ones, enough food for my entire community, because I'm seriously really concerned about the future security of the food production and distribution system.
Right. Me too. Especially if I'm reading the market right. And again, I don't like to look at momentum levels unless they're extreme. And as I mentioned, I'll send you those docs. You could post them here. It's just 2 pictures, but it's very eye-opening. It's very eye-opening because when you see momentum levels at extreme, it's always like a rubber band. It's just a matter of time, and that rubber band stretch. And I'm going to tell you, you tell me, well, you'll see the chart, and I'm being rhetoric, but you will not see the 97% of stocks in the S&P above or below the 50-day line. That's danger zone. That's too much too fast. And something has to come. And when you take that into account with the fact that that on a momentum basis, the market is still has 55-60% of stocks trading below the 200-day moving average, that's a recipe for a major decline.
Well, Roger, I kind of hope you're wrong, but I think you're right. And let's leave it there for now. And going into the weekend, that's some pretty serious stuff to think about. And I'll look forward to talking to you next week during the roundtable and see what we come out of the weekend with, what news changes our attitudes or perhaps strengthens the arguments you've made. But thanks very much for your input again on this Friday.
Thank you for having me, James, and have a wonderful weekend. Take care, everyone.
You too.